markets are closed. Business store. Asian shares mostly gaining Thursday, lifted by optimism over Nvidia's brief surge in market value. This comes as investors largely shrug off U.S. President Donald Trump's latest tariff salvos. Nvidia cements its status as one of Wall Street's most favored stocks, becoming the first company to reach a $4 trillion valuation. Japan's Nikkei 225 and India's Sensex are currently in the red, while the rest are in the green, with South Korea's Kospi rising the most at more than 1%. In the currency markets, the US dollar is flat against the Japanese yen, the Hong Kong dollar and Singapore dollar, while it depreciates against South Korean won and Thai baht. The Australian dollar, meanwhile, appreciates against the greenback. In commodities and crypto, gold prices rise by 0.3%. Oil markets are mixed. In the cryptocurrency space, Bitcoin falls by 0.6%, while Ethereum rises by more than 1%. 7 more countries get tariff letters from U.S. President Donald Trump. They include the Philippines, where Trump set the tariffs on exports at 20% effective August 1. This is higher than the 17% earlier set on April 2. The other countries, Algeria, Iraq, Libya, and Sri Lanka, have a 30% tariff rate, while Brunei and Moldova each got 25%. Trump earlier sent letters to 14 nations, including South Korea and Japan. The tariffs are part of Trump's America First policy. The Philippine government will renegotiate the 20% tariff imposed by the Trump administration on Philippine goods. In a news briefing earlier today, Frederick Go, Special Assistant to the President for Investment and Economic Affairs, said he, together with Trade Secretary Maria Cristina Roque and other officials, will fly to Washington to meet with their U.S. counterparts.
We are concerned that the U.S. has decided to impose a 20% tariff on Philippine exports. The fact remains, however, that the 20% rate is the second lowest among all reciprocal tariffs that the U.S. has imposed on the region, the lowest being the 10% of Singapore. But more importantly than all of this, we remain committed to continuing negotiations with the United States in good faith to pursue a bilateral comprehensive economic agreement, or, if possible, an FTA. So myself, together with DTI Secretary Chris Roque and Undersecretary Perry Rodolfo and Undersecretary Alan Hepty, will be flying to the United States next week. This is actually a scheduled trip to the United States even before today's announcement, no? So there will be meetings next week amongst the trade representatives ng Amerika po at ng Pilipinas.
It's a full assault on Brazil, with President Trump slapping the South American country with 50% tariffs on imports. Trump's tariff order was in his letter to Brazilian President Luiz Inácio da Silva, where he also expressed anger for the trial of his friend, former President Jair Bolsonaro. Trump also ordered the U.S. Trade Representative's Office to launch a probe on alleged unfair trade practices by Brazil, and this could lead to more tariffs. Brazil is the 15th largest U.S. trading partner, with total two-way trade worth $92 billion in 2024. President Trump has also notified other countries of higher tariff rates as he pursues his America First policy and reorders global trade. Here's a list of countries and the new tariff rates announced this week compared to rates set last April 2. Several countries, including Algeria, Indonesia, South Africa, and South Korea, will see the same rates that were announced back in April. The figures range from 25% to 36%, being the highest. Brunei, Japan, Malaysia, and the Philippines will face slightly higher tariffs. Most of them have a 1% increase. Meantime, here's a list of countries with lower tariffs. To recall, Trump suspended all but 10% of the April rates until July 9 to allow more time for negotiation. That deadline has now slipped to August 1. Let's get more reactions on Trump's 20% tariffs on Philippine goods. Joseph Purugana joins us via Zoom. He's the co-convener of Trade Justice Filipinas Network, and he's also co-director of Focus on the Global South, a progressive regional think tank. Good afternoon, Joseph.
Good afternoon, Mai.
So some say Trump's tariffs will have little effect on the Philippine economy, while others are saying otherwise. What's your take, given that the U.S. remains the primary destination for Philippine exports?
Well, as what we've heard in the report prior to this interview, the Philippine government has expressed serious concerns. So this is not something that we can take lightly. No, so what will be the effects? For one, it will mean that our exports to the United States will become more costly, which would then have repercussions on the level of domestic production. So higher costs would make our exports less competitive. And here, one major concern is also in relation to our ASEAN neighbors, no? Vietnam in particular.
Yeah.
So even at an earlier rate of 17% announced in April on what called the Liberation Day, the government was already worried that this will have an impact on export competitiveness. And now that Vietnam has also entered into a deal already with the US, the first in Asia, so this has really become I think a much bigger concern for the government.
Yes, so Philippine exports will now be 20% more expensive. Can you explain just how big is our exports to the U.S. and what products are these?
Yeah, as you said, no, the U.S. remains one of the top export destinations for the Philippines. So the trade with the U.S. amounts to, based on USTR estimates, $23.5 billion in 2024. The U.S. exports to the Philippines around 9.3 billion, while the U.S. imports from the Philippines a total of $14.2 billion. So there's a trade deficit, and this is what Trump has been harping about. If you read the I think very strongly worded letter of Trump, so he was really assailing the Philippine government for this trade deficit. So I think that is the part of the narrative of Trump, is that all of a sudden the U.S. has become a victim of this global trade, no, and a regime that it had helped create in the first place. No, the imbalanced trade that now exists is partly because of the policies that the U.S. has, enacted and also imposed globally. So I think that's a big part of it. What goods? Primarily electronics exports, semiconductor exports to the U.S. So this includes also like ignition wiring, but there are also other manufactured goods and agricultural products like coconut oil, and then also textiles, garments, and apparel are also major Philippine exports to the U.S. that would face now higher tariffs. No, I'm not sure, because in the Liberation Day announcement there was a exemption. No? A number of products were exempted, including semiconductors. It's not so clear to me, reading the letter of Trump, the more recent pronouncements, whether those exemptions stand. No, because if not, and as I said, semiconductors is a major export to the U.S., then it doubly becomes a big concern for the Philippines.
Right. Now, Ambassador Romualdez and even Special Assistant to the President, Frederick Go, earlier said that the Philippines will renegotiate with the U.S. Are you optimistic this tariff can still be lowered?
Well, I think the more critical question for us is what will the government be willing to compromise bring the US tariffs down. And I think realistically, it cannot be brought down to zero, but realistically just to 10%, which was what was being targeted. So I think that is the more critical question. No? That is what we're more worried about, that the government will trade away existing protections to domestic agriculture and industries. As I said in the letter, Trump assailed what we feel in a mafia boss tone, the Philippines' tariff and non-tariff policies that to him caused the trade deficit with the US, which he considers a threat to their economic and national security. But these policies that we have are in place for a reason. They are meant to support local food producers. They are tools to develop and support industries, to move up the value chain to regulate food safety. So as I said, the bigger worry is that the renegotiation, in effect, will mean capitulation to Trump's demands.
Mm-hmm. What do you see are some of the long-term implications? For example, how much of an impact will it have on jobs?
Yeah, I mean, even before the announcement, we have already seen job losses, particularly in the manufacturing sector. So, especially given that we are pushing for this development path that is export-driven, so an effect on making our exports more expensive and less competitive would also have implications on domestic production, and by that also implications on jobs. And so as I said, there are already layoffs reported in the manufacturing sector. So this is worrisome as well from that point of view.
Yes. Now, other ASEAN countries are getting higher tariff rates. How will this now affect the Philippines?
Well, our view on this, we reject the idea that this new tariff structure could be viewed as an opportunity for the Philippines, to try to edge out its neighbors, given that we, as was mentioned in the report, we are the lowest as far as ASEAN is concerned. No? So we reject that notion, that this would then make us more competitive and we can use it to entice more investments to move to the Philippines. Rather, we see this as a race to the bottom that eventually benefits only the US and other rich countries, in particular the transnational corporations that control the supply chain. So rather than discussing how we can edge out our neighbors, we must really move towards rethinking trade, no? And like, for example, how do we deepen regional solidarity within ASEAN? How do we broaden and rebalance trade relationships, no? Especially with nations that respect development, sovereign development paths and do not use trade as a political cudgels.
Yes.
So for us, that should be the direction, no? Not looking at this as an opportunity for the Philippines.
Well, experts have said this can open up more opportunities with other countries in the region, like we foster a healthier relationship with our trade partners. But what should the Philippine strategy be to get through this or somehow cushion the impact on the Philippine economy?
I mean, if you look at the structure of trade now, we're talking about supply chains, right? And really for us, there's really more reason for developing countries like the Philippines, like Indonesia, like Vietnam, to actually work things together, because we are at the tail end of the supply chains, and the countries, the more developed countries, and the transnational corporations that actually control the chain wield so much power in determining not just who gets access to these resources, but the level of who benefits as well from the supply chain. So our position is that it is better that we try to foster more solidarity within ASEAN, and that we must maybe look at shifting the course towards an economic strategy that is centered on meeting the needs of our own people, domestic needs, reviving our manufacturing, supporting domestic industries, ensuring food, energy, and wage security from within. So in other words, we need a development path that prioritizes resilience over dependency and sovereignty over subservience.
Joseph, appreciate your insights. Thanks so much for your time.
Thank you.
Joseph Puruganan, co-convener of Trade Justice Filipinas Network. Foreign direct investments into the Philippines rebound to $610 million in April. Data from the Bangko Sentral shows this is up from $498 million in March and $570 million in the same month last year. It's also the highest since January, $731 million. The BSP attributes the increase to higher net inflows from non-residents' investments in debt instruments. Physical infrastructure, that's the top concern the government must urgently address to improve the power sector, according to Energy Regulatory Commission Chairperson Mona Lisa Dimalanta. On Bilyonaryo News Channel's Business 360, Dimalanta acknowledged that upgrading infrastructure will be challenging, but one that is crucial for delivering long-term benefits to Filipino consumers.
The first issue we need to address is really the physical infrastructure. We have a lot of renewable plants, for example, coming in. Those electrons are desired. We want those green electrons to flow because we don't have to pay fuel for those electrons. We don't have to import fuel for those electrons. But if we don't make sure that the wires are there, that the poles are there for these electrons to get to our homes, then what are those plants for, right? I mean, those will be what we call what I call the tragedy of our time, the stranded assets.
Dimalanta also expressed support for the removal of value-added tax on electricity bills, questioning where the collected taxes actually go.
We have the highest, one of the highest, we're second only to Singapore among our neighbors in terms of the level of power rates that we pay. But that's also because our rates are not subsidized. Not only are our power rates not subsidized by the government, it's also bearing heavy taxes. So take out, if government cannot extend subsidy, then maybe take out the taxes so that the burden would be less. But ultimately, I think it's a call that needs to be made by Congress and our economic managers, because they have to. I must admit, I do not see the full picture. I do not know what those taxes are used for.
Linda Yaccarino, Chief Executive Officer of billionaire Elon Musk's social messaging app X, has resigned. Her departure comes a day after the company's Grok chatbot began pushing anti-Semitic content in response to users. But it's not clear if the two events are connected. Yaccarino had been leading efforts to rebuild advertiser trust after the app, formerly known as Twitter, lost major advertising dollars following a series of controversies. She gave no specific reason for leaving. An equity analyst says replacing Yaccarino will be a tall order for Musk.
Look, Linda's a key part of the foundation of X. You know, her leaving, it's definitely, I believe, a step back for X and a worry for the platform. She was so instrumental. She's obviously going on to other things, but it's definitely a loss for Musk as well as the X platform.
We're taking a short break. More business stories are up next. You're watching Business Brief. Mid-level property prices are taking a hit across Metro Manila, with developers forced to offer bigger discounts to move inventory. From Makati, here's Sujin Kim with what's driving the shift. Go ahead, Sujin.
My rental rates continue to slide across Metro Manila's key districts, with some areas now posting the lowest level since 2010. At the Lichu Property Consultants' second quarter briefing, experts noted that from the Bay Area to Alabang, landlords are cutting prices to fill vacant units amid oversupply. Rents have plunged by more than 50% in some locations compared to their pre-pandemic peaks. particularly in the Bay Area or Pasay City. Condo take-up inched up to more than 6,000 units in the second quarter, marking a 2% quarterly increase. But that remains a far cry from the 11 to 15,000 units sold per quarter before the pandemic. Inventory remains heaviest in the 2 to 7 million peso mid-income segment, with large clusters in Quezon City, the Bay Area, Ortigas, and Alabang. Developers are shifting their focus to upscale and high-end residential projects where buyers remain active despite continued pressure on rental yields. In contrast, mid-income condos are struggling with slower take-up and steeper discounts. Meanwhile, rents in the country's most exclusive villages have proven more resilient, even ticking up slightly in Dasmariñas village. Ultra-high net worth demand remains stable, in sharp contrast to the rest of the residential leasing market. Meanwhile, prime subdivisions south of Metro Manila are trading at just one-third the price of Makati's core villages, offering upside for investors seeking land-based assets without paying a premium for the address. In a strong showing of recovery, the Philippine property market is regaining momentum across commercial, tourism, and capital segments. In the office sector, Lichu property consultants report that leasing volume in the first half of 2025 has already reached two-thirds of last year's total, putting the market on track to surpass 1.2 million square meters by year-end. Still, uncertainty remains. Global tensions and looming tariff shocks, especially from the United States, could disrupt the current rebound. BPO firms remain the biggest source of demand, led by global in-house centers and traditional players in technology, banking, and insurance. And those are latest updates from Makati City. Back to you, Mai.
Thank you for that report, Sujin Kim. The 15% tariff on imported rice will stay in place until November. That's according to the Department of Economy, Planning and Development, or DepDev, as the government aims to balance inflation control with support for local farmers. Rosemary Edilion, DepDev Undersecretary for Policy and Planning, says they will submit their study to President Bongbong Marcos in 4 months. The announcement comes amid calls from farmers groups, including the Samahang Industriya ng Agrikultura, to restore the original 35% tariff to protect local producers from cheaper rice imports. The Department of Agriculture, meanwhile, plans to recommend a gradual tariff increase during the next harvest season. The impending 50 pesos daily minimum wage hike in Metro Manila is unlikely to drive up inflation. This is according to Ruben Carlo Asuncion, chief economist at Union Bank of the Philippines, who points out the wage hike's limited coverage. Jonathan Ravela, senior advisor at Reyes Tacandong and Company, calls the increase a well-calibrated move, saying it boosts worker income without significantly impacting inflation. The 50 peso wage hike in the National Capital Region will take effect July 18. Philippine shares back at the 6,400 level after snapping its 3-day winning streak. The PSE index ended lower by 0.6% to close at 64.63, finishing the day as the worst performer in Asia. Majority of the sectoral indices ended in the red, with financials falling the most at more than 1%. Advancers outpaced decliners 107 to 85. Total value turnover reached 9.4 billion pesos. A mixed picture dominates the Philippine equity market, with Ayala Land falling the most at more than 3%. DigiPlus rising the most at more than 8%. Meanwhile, at the foreign exchange market, the peso currently trading at 56.43 against the greenback, appreciating from the previous close of 56.57. That's a wrap for today's Business Brief. I'm Mai Rodriguez. Join us again tomorrow as we bring you the stories that help you plan your next big, bold moves in business, only here on the Bilyonaryo News Channel. See you then.